This company makes bolts, pumps, and ignition systems for airplanes. Its profit margin beats almost every software company on Earth. Since 2006, it turned $21 into about $1,200, beating the S&P 500 roughly 3-to-1. It pays no normal dividend. Yet, it has borrowed billions to hand shareholders $248 a share. And the Pentagon's own watchdog calls its pricing gouging. This is TransDigm, the most profitable monopoly you've never heard of. Let's open it up. Start with the number that shouldn't exist. In fiscal 2025, TransDigm did $8.8 billion in sales and kept 54% of it as core profit, 54% margins on aircraft hardware. That's software company profitability on pumps and latches. For comparison, most industrial suppliers live on 15 to 20%, and it's still growing. Last quarter, sales jumped 18% to $2.5 billion. Management just raised the full-year outlook past $10 billion. This is not a sleepy parts maker. It's a profit machine. So, how do you earn software margins on bolts? One word: sole source. About 90% of TransDigm's sales are proprietary products. Around 80% are sole source. Here's why that matters. When a TransDigm pump or actuator gets designed into a new jet, it's locked in for the 30-year life of that aircraft. No competitor can bid. The airline has to buy the replacement part from TransDigm at TransDigm's price. It doesn't sell components. It sells tiny, certified monopolies. Thousands of them. Now, the part Wall Street loves most: the aftermarket. About 55% of revenue comes from replacement parts, not new plane sales. Think about what that means. New aircraft orders swing with the economy, but planes already flying need spares every year, forever. That aftermarket revenue behaves like a software subscription, recurring, high margin, and almost impossible to cancel. So while Boeing and Airbus ride brutal production cycles, TransDigm collects a toll on the entire global fleet every time a plane lands. Here's what TransDigm actually is: a private equity firm wearing a public ticker. The model is ruthless and repeatable. Buy a small maker of sole-source aerospace parts. Apply pricing power. Cut cost, expand the margin, then borrow against those cash flows and do it again. Over 2 decades, it has rolled up hundreds of these niche monopolies into one machine. This is why management obsesses over one metric: return on every dollar invested. Not revenue, not size, just returns. If you like finding the company behind the trade, subscribe. Next in this series, the utility that quietly became an AI data center landlord. Now, the track record, because it's almost hard to believe. A $21 share at the 2006 IPO is worth around $1,200 today. That's roughly 23% a year for nearly 20 years, with dividends reinvested north of 30% a year. The S&P 500 did about 10. And here's the twist on cash returns. TransDigm pays no regular dividend. Instead, it fires off giant special dividends, $248 a share since 2019, including a $90 payout last September. But that compounding has a fuel source most investors gloss over: debt. TransDigm carries about $27 billion in net debt, 5.8 times its annual core profit. That's not an accident. It's the strategy. Management deliberately runs leverage between 5 and 7 times. Every special dividend you just saw, largely borrowed. The logic: if you can earn more on capital than it costs to borrow, you borrow as much as you safely can. In a world of stable, recurring aftermarket cash, it works beautifully. The question is, what happens when the world isn't stable? Because here's the crack in the armor. That same pricing power has a powerful enemy: the U.S. government. The Pentagon's Inspector General has accused TransDigm of excess profit, price gouging, not once, but 3 times. In 2019, $16 million in excess profit on 47 employees. TransDigm refunded it after a congressional hearing, then a finding of $20 million more, then another $21 million in 2021. The loophole: on small sole source orders, suppliers don't have to show their cost data. Close that loophole, and the defense margin takes a hit. 2 more risks worth tracking. 1, that debt. 5.8 times leverage is great when rates are low and planes are flying. It's a vice when either reverses. Higher for longer rates raise the cost of every refinancing. 2. The cycle and the price. Commercial new plane build rates have been soft, and aftermarket growth is cooling from its post-pandemic surge. Meanwhile, the stock trades near 27 times forward earnings, a premium that assumes the machine never slips. In February, KeyBank stepped to the sidelines. Put the numbers side by side. TransDigm trades around 27 times forward earnings and roughly 23 times enterprise value to core profit. For a company growing high teens with 54% margins, bulls say that's fair. Bears say it's priced for perfection. Wall Street's average target sits near $1,560 above today's $1,200, but coverage is thin, only a handful of analysts. This is a stock institutions own and retail ignores. At a roughly $70 billion market cap, the easy money was made. The question now is durability. So, where do I land? In my view, the moat is the most real thing in this entire market. Sole source parts on 30-year platforms don't disappear in a recession. The risk isn't the business, it's the balance sheet and the politics. The leverage amplifies everything up and down, and the Pentagon scrutiny is a slow structural headwind on the defense side. TransDigm isn't a stock you trade. It's a compounding engine you stress test against rates and against Washington. My base case for the next 12 to 18 months, most likely the compounding continues, but at a calmer pace as aftermarket growth normalizes. Watch 3 signals. First, organic growth. It ran 6 to 11% last year. A slip below 5% means the aftermarket engine is cooling. Second, core profit margin. It's about 54%. A sustained drop under 52 would say pricing power is finally meeting resistance. Third, leverage. It's 5.8 times. A move toward the 7 times ceiling or a credit downgrade would pause the special dividends. Upstream, TransDigm rides Boeing and Airbus build rates and the health of the global fleet. Downstream, every airline on Earth pays its toll. The catalyst that lifts it, another fat special dividend. The one that breaks it, Washington closing that pricing loophole. TransDigm sells the most boring products imaginable and turned them into one of the great compounding stories of the century. The bull case is the monopoly. The bear case is the debt and the politics. At 27 times earnings, the market is betting the machine keeps running. For 2 decades, betting against it has been a mistake. That was the second in our company deep dive series. One stock, all the numbers, no hype. I'm Big Z. Follow me. See you in the next deep dive.